The terrifying truth revealed. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, global leaders are in shock as an imminent crisis approaches, and I want you to understand that this was not supposed to happen. Global leaders asked citizens to trust them and to believe that they had the answer to all their problems, and as you're about to see, they had no answers. They made every wrong possible move, and now what's coming is something that they can't even stop, which is why they're outright terrified. Now let's head over to S&P Global, where we picked today's story up, as we head over to Germany, because this is going to be one of the epicenters of the next crisis. As we look around the world, we've identified issues in China with the property market. The U.S. has an impending commercial real estate crisis, and meanwhile, central bankers all over the world say there's nothing they can do. They see no problems at all. And now we turn to Germany, where things just got significantly worse. But business activity rises only marginally in June as growth slows, but it's underneath in the manufacturing sector. We see the danger as services activity posted another solid monthly increase despite the upturn losing some momentum. And the belief had been that the manufacturing sector was due to slow down because during the pandemic, consumers all over the world had pocketfuls of money and they spent it. And now they were looking to spend their money on services, and the popular belief was that the services sector would drive the manufacturing sector higher, and it turns out that's not the case at all, as the main drag on the headline index came from renewed weakness in manufacturing production, which after coming close to stabilizing in May, fell at a solid and accelerated rate that was the quickest for 3 months. And you might not remember, but a matter of months ago, people were celebrating that the Eurozone was coming out of recession, that the German manufacturing sector that we said was in a depression was moving upwards and everything was going to be fine. And now we're finding out that it wasn't fine at all. We told you that was a likely case, that where this was going to get much worse, as the dichotomy between growth and services and the contraction in manufacturing was also observed with respect to new business. Moreover, the decline in factory new orders was sharp and such that it offset a modest increase in services. And this is a huge problem, because when you look at the manufacturing sector versus the services, wages on the manufacturing side are generally significantly higher than the average services job. So when you see new orders collapse, it tells you that the next thing to go is hours are going to get cut and then jobs are going to get lost. And when those higher wage employees hit the unemployment line, their spending is going to plummet because the benefits they get on unemployment are only a fraction of what they're used to, and that lack of money getting injected into the economy sets the stage for the next recession. Now, as we look to Germany, suggesting it's going to lead the entire Eurozone down in a matter of months, and stronger demand, well, that was coming by a second straight monthly rise in new business from abroad, and that was the problem because the manufacturing export sales, on the other hand, fell at the quickest rate since March. So they're getting business from abroad, but sales are just not enough. And if you're looking to make some money, well, the oil market, look at this headline: oil prices post weekly gain as traders weigh impact of growing Middle East tensions. And you know, when you see headlines like this, it means the energy sector is going to boom in the near-term future. Now, we told our subscribers on our CTA Timer Pro, because we look at the machine positioning every day, and when we see machines in deep short position and price start to move against them, they have to short cover, which is why last week we told you the machines were going to buy $30 billion worth of oil. Well, we got in it first. That's what we do. Here you see back on the 11th of June, I said this was a low conviction trade that popped up on our reports. I told our subscribers to pass on it, and the next day we got the signals we wanted. And I said yesterday my conviction was low, but today there it is. Here's your upside target. Here's your stop loss. Well, we blew through the upside target, and just want you to understand, making money is that easy. Look at this. We're out at 9 days from the onset of that trade. You'd be up 2.37%. We give you all the signals. In fact, on the weekend today, we went through all our open trades, show you where we're up, where we're down, and we're up far more than down. We give you updated stop losses. We do everything. The worst thing you can do is sign up for a 30-day free trial and start making money trading. Yes, we make it that easy. I hear my competitors only have 1 out of every 5 trades that are good. Not us. We got that beat by a long shot. But one thing that isn't getting a beat is the private sector employment in Germany, marking the first decrease in 3 months. There was another job creation in the services sector linked to increasing workloads and hopes for greater activity in the coming months. But it's just about hope. Now, you think about the summer months. Of course, that's when hope in the services sector exists because people hire up for this. People go on vacation, they spend money. This is where the services sector tends to do extremely well. So you see a lot of seasonal factors here showing up in these reports. And the pace of hiring, though, slowed noticeably from that seen in May to a 3-month low, suggesting a deceleration in hiring. The decline in factory payroll numbers, this is the big one, extended to a 12th straight month, although it eased to the weakest since January. Again, putting more high-paid workers on the unemployment line, telling us that Germany is indeed heading into a all-out depression. Remember, they are the manufacturing base of the Eurozone. They are the strongest industrial power. When they go, every peripheral country around them goes. And keep in mind, their biggest export partner is China. Well, they're having troubles too, as we've noted on this show. Their property market is dragging down their entire economy. It's only a matter of time before commercial real estate cracks here in the U.S. And you can understand why global leaders are indeed panicking and yet have no answers, as a setback for the labor market came amid signs of a general lack of pressure on business capacity. So even though new orders didn't really rise much, they dropped sharply, though, in the manufacturing sector. Check this out. There were faster decreases in backlogs of work in both monitored sector, with manufacturers once again recording the much sharper rate of depletion. So once again, manufacturers just don't have enough new orders to keep their workforce focused on that. They're just chewing through all their backlogs. Once those backlogs are gone, you're going to see manufacturers are going to trim their workforces down to handle only what they perceive as their demand in new orders. As more and more people hit the unemployment line, demand drops and ripples all over the global economy. And the issue is, we look at the German manufacturing PMI. Again, this is from S&P Global. This is the bottom that everybody was cheering. They said, look, it's over. You see the rebound. You go back to, of course, the global financial crisis. What happened? The PMI's bottom. It went higher. You see during the pandemic, it bottomed. It went higher. Everyone's saying, look, it's over now. We hit the bottom. We're in the second half rebound, and now momentum is stalling out and rolling over. We said that was likely the case. And you think about it, of course, there's likely to be an increase in manufacturing headed into summer because, of course, you see businesses need to restock for summer items. There's demand for this as they need to get their inventory aligned. But we look to what the political elites did. They tried to solve this problem, and I want you to see every move they make didn't work, because now German inflation is edging up again, highlighting challenges to the ECB as central bankers now around the world want to cut, but they're afraid. They fear a rise in inflation. Of course, we know if the labor market is on the unemployment line, inflation isn't going to last too much longer. And while Germany doesn't publish a core inflation reading in its preliminary release, regional data suggests an advance to 3.3 from 2.9 in May, and nowcast models predict a headline number in June of 2.5%, taking, of course, all the latest data into account. So what happened is they saw inflation start to head higher, and that's a problem, because when we note that consumers lose their job and lose their spending power, as we look at total compensation now, this U.S. data shown as the average hourly earnings for production and non-supervisory employees multiplied by the number of hours per week they work. What happens when you look at this against the consumer price index, when you see rising consumer prices, this is exactly what we're seeing in Germany against decelerating total compensation, which tends to happen when people lose their job and there's a lack of work for those who do keep them. What happens with a lag? Inflation comes down, and you see that event happen repeatedly, and notably, it's happened right right as you head into a recession. Now, the U.S. didn't have that happen because, of course, what happened, total compensation started to rise above inflation, but we know that that is not likely to last, as many of the reports are suggesting hours here are getting cut as well. And so the danger sign is that everyone thought Germany avoided a recession, and now it turns out they're headed into an all-out depression. And you can see what, of course, the political elites in Germany did. They gave workers a record pay increase at the start of the year, and it didn't have any effect. And that was their solution as well. Inflation got out of control. People are struggling to pay their bills. Let's just force some pay increases across the board, and it wasn't enough. In fact, it was too little, too late, as a 3.8 advance in real or inflation-adjusted wages from the same period a year earlier was the largest since the time series began in 2008. That supports economists' assumptions that consumers will be driving force behind a modest economic recovery of this year. And that was the hope. You put money in people's pocket, they'll go out and spend it, they'll keep the economy afloat. That there's something all these political elites missed. We told you on the show that this was the issue they couldn't see, as concerns have been tempered by the fact that the increase was driven by one-off payments. And because workers are still catching up to losses, that's the big one, incurred when consumer prices rose faster than their salaries. And this is something, again, the elite can't see. They have too much money, they're too wealthy, they're too much above the average worker to notice the fact that for many years in a row, in fact, what they saw is wages fell way below consumer prices. And what happened? Consumers had to take on debt. They tapped out their credit cards. They then looked to buy now, pay later loans. They took money wherever they can. And of course, central bankers continued to raise rates. They continued to drive the cost of money up. And that meant debt service costs went with it, along with consumer prices. And this is the issue. We come back to the U.S. data. And what do you see here? Consumer prices late 2021 outpacing total compensation. And then you see a deceleration in total compensation that ultimately leads to a decline in consumer prices. But it was this period right here, and we see that all around the world, that this is the problem consumers are facing. Right now, the political elites are saying, hey, what's the issue? We did it. We did our job. We got your pay increases. We got you the hours you need. You should be happy. And consumers are saying, wait a minute, I'm still behind. And that is the problem that we face in Germany and all over the country. And here's the latest issue that's facing, of course, the German economy, the one that could just tip it outright into the depression, as Germany's largest labor union pushes for a whopping 7% boost in wages. The problem is this is in the metal and electric industries or the manufacturing sector. And you can imagine if the manufacturing sector is already in deep contraction, they're seeing their backlogs just get eroded down to nothing. New order growth is slowing down. They're already laying people off. And you have to understand the workers definitely do need raises. But what are the elites saying? Well, no, you don't. And 7% wage demand is on the high side and could be somewhat worrying for policymakers concerned about inflation. Of course, we know that policymakers want workers to get pay increases, just not very big ones. And that's the key. They want to bring inflation down by making sure people stay underwater just a little bit, and that's a key point. And here we can see, even if the union settles for about half their demand, that would still be higher than would be consistent with 2% inflation and optimistically 1% productivity growth. And at the same time, Europe's largest economy is set to remain weak after shrinking in 2023. Remember, where Germany goes, the peripheral nations around the Eurozone follow. Manufacturing in particular is struggling with sluggish demand and trade uncertainty, that means with China, amid looming U.S. elections, strained relations with China, and geopolitical threats. Employers have been appealing to workers, hey, be reasonable. But notably, what happened when employers were making a ton of money because inflation was rising? They didn't share it with their employees. The employees know this. That's why they're demanding concessions now. The problem is employers are not in a position to do it because they're facing a stark reality. If we give out raises, wages, it means more people are likely to hit the unemployment line, and then we are for sure in a recession. Even if we see the situation, the performance of our employees, the situation remains extremely critical. Labor costs are a factor now determining the competitiveness of our economy, and one that bargaining parties can influence, suggesting that Germany's manufacturing sector is no longer competitive, and this will make it even worse. You can see this is a lose-lose situation. The political elites tried to solve it. They tried to create demand in the economy. It didn't work. We told you that was not going to happen, that they were not going to be successful here. Any sort of increase in manufacturing activity around the world was destined to be transitory. It turned out to be the case. As trade unions are still striving to recoup the losses in inflation-adjusted wages from previous years that have not been fully offset, the wage demand remains high, and they're successfully negotiating comparatively strong results. And again, you can't blame them at all, because as you look around the Eurozone, and this is the problem, because we are in a globally synchronized economy. If Europe goes, if China goes, the U.S. is not an island. We can't just magically decouple because we want to. We go with it. The thing is, we are, of course, the cleanest shirt in the laundry basket, but not for long, as Eurozone activity slows on French vote risk, and here it is, a factory slump. Euro's economy remains in the early stages of recovery. That's at least what they're claiming, is starting to roll over from last year's mild recession. But while growth surpassed expectations in the first quarter, recent data suggested momentum may be waning. And what's more, President Emmanuel Macron's shock announcement to call snap elections has brought prospect of radical change in government in the region's second biggest economy, again creating havoc, as flash PMIs, or purchasing manager indices, for June suggests that the Eurozone's growth momentum is still weak, meaning it's rolling over. That's not what you call a recovery. Today's PMIs do not call into question our view that the Eurozone economy will boast another moderate expansion in the second quarter, but they are to a downside risk for the rest of the year if momentum doesn't improve. And you start to think, what would cause the situation to change? Are workers getting big raises? Are they getting more hours? No, they're getting the exact opposite. And if you have a job and you're seeing hours get cut and you're seeing your coworkers lose their job, the first thing you're going to do is cut spending, because you don't know if you're next. If your family is going to be next on the chopping block, you start to build up your savings, you start to cut down on your debt, pay things off, and that's what, of course, turns the tide into economy. They don't think, the elites don't think this will send the economy into recession. They understand the message to workers is loud and clear. The services sector continues to keep the Eurozone afloat. The only question is for how much longer, because we do know where manufacturing goes, services eventually follows. And even though activity didn't pick up as much as last month and fell short of what most analysts were expecting, the overall expansion was indeed solid. My guess is we've got about 2 more months before it rolls over, and something that else is going to roll over that many people are hoping and pinning the success of the global economy on is the United States and getting the Fed to cut rates. And now we might have some real evidence for a change. The Fed will be cutting far sooner than they even think. As we look now to the S&P Global Flash PMI for the U.S. composite, this is manufacturing and services. And what do we see? The manufacturing sector PMI now up to 51.7, a 3-month high. How about the services sector? Boy, it's driving as well. It is now up to a 26-month high. Of course, this is going into the summer months. The question is, will the services sector lag? Based on what I'm seeing out on the street, just with my own eyes, suggests that the services economy is not as strong as everyone hopes. But here's the key part. Selling price inflation cooled to a 5-month low in June, this out of the factory sector, though continued to run above pre-pandemic 10-year averages in both manufacturing and services, to point to some stubbornness of price pressure. The rate of increase nevertheless fell to a 5-month low in the services sector, where the rise was among the lowest seen over the past 4 years, and a 6-month low in manufacturing, suggesting that demand in the U.S. economy is waning. But get this, the PMI is running at a level broadly consistent with the economy growing at an annualized rate of just under 2.5%. The upturn is broad-based as rising demand continues to filter through the economy. Although led by services sector reflecting strong domestic spending, the expansion is being supported by an ongoing recovery in manufacturing, which so far this year is enjoying its best growth spell for 2 years. But this means the U.S. economy growing at 2.5%. What does that mean for inflation? Well, it means it's coming down. Here you can see S&P Global looking at their flash PMI versus inflation. This is output prices shown in blue against the U.S. Consumer Price Index. You see the relationship here where prices come out of the manufacturing sector go, consumer prices tend to fall. They're saying, look, this is a downward trend heading toward the Fed's 2% goal that they don't think they're going to get to, maybe for even a couple years. We know this means the Fed's likely to be cutting sooner than later. It's not just demand that's going in Germany and the Eurozone and China. It's the U.S. It's a global problem. And this is why, of course, global leaders are terrified, because this time they have no answer. They've used all the bullets in their gun, and now they're staring down an economy headed into an abyss. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.